Hi guys, my name's Craig. I want to take you back a little bit to around about March and May 2020. We know that was the period of COVID. May specifically, we know that oil went into backwardation, where you actually had a negative oil price. And you could pick up Sasol shares for under 40 Rand a share. People were convinced that Sasol was going to go out of business. Those that did pick it up at that price did exceptionally well. And every now and again you get another buying opportunity. Now today Sasol's down over 8%, and for me that's quite a serious move. It's largely off the back that Sasol have not been able to deliver all the fuel, mostly due to transportation issues, and as a result there's a huge accumulation of costs. Now we know Sasol management have disappointed in the past by not guiding the market with regard to costs. But as we talk, Brent crude is substantially higher than WTI, sitting at about $94, $95. Fair enough, the Rand is a bit stronger than the dollar on the basis that the dollar has weakened. But the trend is that the Rand has been weakening. And Sasol is applying not only on oil but also on the exchange rate. So you can be picking up Sasol right now for 281, 283 Rand a share. And it wasn't so long ago that it went from 40 Rand to 400 Rand a share. And in my opinion, with oil prices around $95 a barrel, we could easily see a nice recovery in Sasol. The other commodity share that I'm going to chat about a little bit has been a perennial favorite for many investors and traders, and that was Thungela. And of course the coal price went up to about $300 and is now closer to $200, so we lost a third of the coal price. But the reality is that there's still a shortage of coal, there's still a shortage of oil and diesel, and that shortage is going to get much, much worse. So this is a bit of optionality on what's going to happen in the world going forward. Having said that, there is obviously the theory that the oil price will come down because there is obviously a theory that oil prices are at their high and will come down because we're about to enter a global recession. And normally during global recessions there isn't huge demand for oil. However, the global backdrop is a little bit different to the normal situation, and I am by no means a macro person. So let me just share with you my current theory about diesel and oil and where it's going. We're facing a potential problem. We've had 2022 as a very interesting year in the sense that there's been a shortage of coal, and coal is a very interesting commodity, an important commodity in South Africa, because most of our fuel and diesel comes from Sasol. In fact, 40% of South Africa's fuel comes from Sasol, and most of that is coal to liquid technology. So we require coal to produce diesel. Right now, Eskom is continually having problems with their coal-fired energy plants. They've got a lot of diesel power generators, and there's a potential shortage of diesel. 60% of our diesel is exported. Unfortunately, a lot of these diesel producing energy plants are on the coast, and so it's quite easy for that to come. But other diesel that gets exported is being transported by trucks. Trucks run on diesel. And in addition to that, there's a global backdrop where fuel, oil, gas, diesel, whatever you want to call it, is in short supply, specifically in America, where Biden decided to stop fracking after he took over, and he decided when the Russian-Ukraine situation started that he's going to start dipping into their energy reserves, their oil reserves and supplies. And right now there's approximately a month left before those oil reserves in the US run out. We know that the US has always had a very good relationship with Saudi Arabia, but that relationship has been strained of late. Saudi Arabia want to join the BRICS nations, and there's a very good chance that the US is going to struggle to find oil reserves. Russia is obviously a big producer of oil, and there's no way that America will ever consider getting oil from Russia. So we now, the start of November 2022, it's my belief that the next month before 2022 ends, the big topic of conversation is going to be the availability of oil and diesel. We know historically many wars have been fought on the basis of oil and diesel, so one doesn't want to panic about it. Essentially, fuel and oil, besides the threats of war and other big geopolitical issues, it's the biggest driver of inflation. And so if you've ever wondered whether the Fed is going to pivot, my answer is not well. Inflation continues to soar. And with a backdrop of high oil and high diesel prices and a scarcity of it, those prices are not going to come down, they're going to escalate further. So with a backdrop of extremely high diesel and oil, short supply, there's no question that the prices of diesel is going to continue to escalate. And if it continues to escalate, inflation is going to continue to escalate. Even though inflation is currently on a high base, I still believe that we're going to see increases in inflation. The result is that the current monetary policy of most central banks is to try and curb inflation. They increase interest rates. Higher interest rate pressure in turn reduces consumption, and reduced consumption, reduced capital expenditure when you have high interest rates are all contributors towards a recessionary environment. And right now, indications seem to be very clear that 2023 is a global recession. Coming back to South Africa, because most of my viewers are South African and I'm South African and operate in a South African environment, we have only one electricity supplier, Eskom. We know Eskom is under financial strain. Governments have indicated that they're going to remove some of that 400 billion off Eskom's balance sheet. Obviously those liabilities, probably to the tune of about 130 billion, will fall on the South African government for repayment. And but that doesn't mean that Eskom will get out of its situation, because NERSA has limited the escalations that Eskom can pass on to the consumer. And normally to generate 1 kilowatt hour of electricity via the one nuclear plant in Coburg and the various coal plants that Eskom have cost approximately 1 rand per kilowatt hour. In the case of using diesel to generate electricity, the cost is approximately 5 rand per kilowatt hour. So the longer that Eskom cannot keep its plants running, and the more reliant they are on diesel, the bigger the debt that Eskom is going to accumulate. Obviously, besides fuel and diesel costs, which filter into transport, and almost every single good needs to be transported. So that is the biggest inflationary driver. The second biggest inflationary driver is probably the wage bill, and following that, electricity, because every single business, every single factory requires some form of electricity. And if electricity gets pushed up, which is very likely, not necessarily in the short term, but after 2023, 2024, we expect that electricity inflation is going to be far higher than what we've used to, even though we have seen some significant price increases. So that's the gloomy news, and it does help one position to say, well, if we have this as a global backdrop, inflation, high interest rates, we should be positioning our portfolio accordingly. If diesel is something that's going to be in demand from a South African perspective, one of the shares that I acquired in my longer term portfolio was some Sasol. At current prices, I still think Sasol's an opportunity to be overweight in your portfolio. Thungela is a coal producer who export mostly to India, but because of getting coal to Richards Bay and to various terminals for export, it may be feasible for Thungela to also consider alternative markets to supply. They have indicated that they will not be supplying Europe. There's still a shortage of coal, and likely to be a shortage of coal in the world for a while. Thungela certainly is starting to look attractive, even though it has run substantially over the last year. In addition to that, I've been holding HCI for a while. It's a diversified, find Johnny Copeland and the guys at HCI are pretty good capital allocators. Not that excited about ETV and some of their entertainment assets, but certainly Montauk Energy, the exploration with Total and the various oil opportunities make HCI extremely attractive and potentially trading at a huge discount to NAV. Very much a long-term play, but even at the current prices, there's a potential to double over the next year, in my opinion. And again, this is not an investment advice. So these are just things to keep in mind when positioning your portfolio. Sometimes inflation can be good for companies because they're able to pass on those costs. But in many industries, in the short term, inflationary costs are absorbed by the companies, and they aren't always able to pass them on to the consumer, especially when you operate in a highly competitive industry. Of course, I don't believe in only investing in equities. In fact, I think if you look at the way equities perform in interest rate cycles, when interest rates are rising, it's generally not good for equities. Now, we have seen stock markets come under pressure, but I don't believe that it's over yet. So my feeling is that one should be a little bit underweight equities and look for selected opportunities. I also think that there are opportunities for short positions to try and make your portfolio a little bit neutral. Certainly at current interest rates, bond yields are attractive, but keep in mind that if interest rates are still going to escalate another 200 basis points, as an example, then you're going to take some capital pain on bonds. So you don't want to be too heavy into the bond market. Inflation-linked bonds used to be extremely attractive. In the current South African market, the yield is not that great, but if you're prepared to lock your money away for 2 or 3 years, you can be getting anywhere from 10.5 to 11.25% on RSA retail bonds, which don't present any capital risk but provide you with a very attractive yield.